The opinions expressed on this program represent the viewpoints of individual authors or contributors and do not necessarily reflect those of Troy University.
Hello and welcome to EconVersations. I'm your host, Dr. Dan Sutter of the Johnson Center for Political Economy at Troy University. One of the more enduring and controversial policy issues across the nation and here in Alabama over the last decade or so has been payday and title lending. At the national level, the Consumer Financial Protection Bureau recently proposed new regulations on these lenders, while in Alabama, Governor Bentley announced the creation of a task force to study the issue. The policy concern, though, highlights the need to probe the underlying question. Is there a problem with payday lending? And if so, what exactly is the problem and how could it best be addressed? Joining me on the show today to discuss this question are Dr. Dan Smith, the Associate Director of the Johnson Center, and Christy Bronson, a Troy University economics major who wrote a research paper on payday lending earlier this year. Welcome back to the show, Dan.
Thank you.
And Christy, welcome to the show.
Thank you for having me.
Before we get started talking about payday lending, Christy, just tell us a little bit, like, how did you get to Troy University here in Alabama?
I chose this university because it has a great economics program. I'm interested in Austrian economics, and I wanted to get away from cold weather. I'm from Massachusetts, so.
Well, I certainly don't have to worry about any cold weather this summer. It's been quite warm. So, okay, well, let's get started then. If you could start here, just tell us what exactly is payday lending, and we sometimes hear also title lending. Is there a difference that's really sort of like important between these two different types of lenders?
Yeah, so the basic distinction for a payday lending loan is that it's unsecured, and that's why it's called payday, because the lender will look at your pay stub from the last week and say, okay, this is how much they make, and they're going to get this check presumably in 2 weeks again, as long as they don't get fired in between, and then they'll be able to pay off this loan. That differs from like a title loan where you bring in a title, typically your title to your car, and say, I want to take out a loan on this title. And you give the title to the lender, and they hold on to it as collateral for the loan that they give. Now, pawn is even something a little bit different in that you bring an object of value, usually of personal value and objective value, let's say like a Fender, a guitar, or something like that, and you give it to the pawnbroker, and they hold on to it in exchange for a loan. And if you don't pay off that loan in a specified amount of time, you give up the rights to that item, and the pawn shop can then sell it to another customer to make up the loss in that loan. So the key distinction is that payday lending loans are unsecured.
Okay. And so then the payday lenders have been around for, it seems, a decade or two now, is a reasonably long period of time. If you could tell us a little bit about, if you went into a payday lender, what type of a loan would you be taking out? What size of loan? How long might this loan be for?
Yeah, so the typical payday lending loan is under $400. It's usually for a 2 to 4 week period. The vast majority of them are under 4 weeks, and that's even with renewals. And it's typically, the financing charge is about $20 for every $100. So if you took out a $400 loan, it's going to amount to $80 fee for that loan. So you end up paying back $480 in 2 or 4 weeks whenever you pay off that loan.
Now, one of the things you hear is that these lenders are charging interest rates, something like 400%, sometimes even higher. You see some very high interest rates get quoted. Are they actually charging such rates, or is there something a little sort of a little more that we have to talk about in terms of understanding that?
The interest rate is an annual percentage rate that they're saying that it would be how much you'd be paying if you were going to take the loan out over a whole year. But like he said, it's only around 2 to 4 weeks that they're actually having the loan out. So the fee might seem really large, but it's not the full picture of what you're actually taking out.
And although a lot of times these fees and interest rates seem pretty high, if you look at like a traditional bank, and if you have like a bounce a check for a traditional bank, or late payment fees for credit cards, do you end up getting like charges that are of a similar magnitude to what we're seeing from the payday lenders?
Bounce check fees are actually higher than the payday lending fees if you converted that to an annual percentage rate. So yes, they do have other ways of getting that money, even if it's not through a higher interest rate.
Now, one of the things that many people react to when they first hear about some of the payday lenders and some of the interest rates they'll be charging, they'd be saying like, well, don't we have like usury laws to restrict this? So how do these how do these lenders even get to survive? Aren't they violating usury laws? And I guess probably before we talk about whether they're violating usury laws, we may want to talk a little bit about, make sure everybody understands what we mean by this term usury. So
usury laws, I mean, they go back thousands of years, perhaps even. I believe even Aristotle talked about excessive charging, the excessive charging of interest rates on loans, and how that was immoral and evil. A lot of states do have these laws that prevent certain excessive charges on loans. But for the most states do not apply these loans to the payday lending industry. And that is because they see these as two separate, they're apples and oranges. Compare commercial lending, which is usually 30-year mortgages, 10, 15-year commercial loans, versus a short 2 to 4 week loan. This is two completely different things. It's like looking at the taxi industry and saying they should be charging the same dollar amount per mile as the commercial airline industry. You're talking about two different modes of travel. Taxi cabs are short distance, you're going to charge a lot per mile, whereas taking a flight, you can, for a couple $100, you can go from pretty much anywhere in the United States, and the cost per mile is relatively low. So states oftentimes see that there's a distinction between the terms and length of these loans, and therefore regulate them differently and do not apply these usury laws to payday lending.
So it's a little bit misleading to say that these lenders have been exempted from usury laws. It sounds like it's more like the case is determined that they were actually doing a slightly different type of business, and a different type of regulation was appropriate for this slightly different type of loan compared to like the longer loans, right?
Yeah, another interpretation could be that usury laws were put in place and that this new industry emerged and kind of saw a gap in the regulations and was able to exploit that gap. But they are meeting regardless, they are meeting an important need. And most of the calls today for payday lending restrictions would be applying some type of usury law to the payday lending industry.
So I guess the next question we want to try to get into is this question, since this is related to usury, or for hundreds or thousands of years we've had this stigma attached to lending at really high interest rates. Is there some kind of ethical problem? Certainly a lot of payday lenders are portrayed as if they're sharks or worse in the media. What are they actually doing, and do we think that there's any kind of a ethical problem with their actions of payday lenders?
Yes, so to make the ethical judgment, you really have to understand the economics behind it. If Bill Gates came in and asked me for a $400 loan for 2 weeks, even without security, no collateral, I would probably lend it to him at a fairly low rate because I would see it as very low risk. However, if someone with a minor criminal history, poor financial history, they've gotten in some problems in the past, shown financial irresponsibility, and with no collateral to speak of, came in and asked me for $400, I'd probably be a little more skeptical about giving that to them without being compensated for that risk. And that recognition that the cost of that risk is important to calculate and incorporate into the price of that loan, the interest rate or finance charges applied, helps understand the ethical implications, right?
So are people really taking out these loans then sort of voluntarily, or are they somehow being coerced or forced into taking out such loans?
No, people actually choose. They, in some cases, they have other options, but they are voluntarily choosing to use the payday loans because it's helping them out. They need the money for usually emergency expense, and they don't have in their a better way to get it, so they go to the payday lenders.
And I guess as we talked about earlier, I mean, if they are facing like late charges for bills, or they would have to bounce a check if they didn't have the money otherwise, then as we've already established that, yeah, they're paying a lot for a payday loan, but their other options might even be worse than that. And so, in some sense, you could say the payday lenders are trying to help some of these individuals caught in circumstances like this. Now, I think one of the things that's interesting is, I guess, if you doubted whether or not the customers of payday lending are actually being made better off, because I mean, I think maybe some viewers might be skeptical of that. It's one thing you could do is ask them. And Christy, that's essentially what you did with your project that you did earlier this year. So tell us a little bit about, before we get into some of the findings that you found from the survey you conducted, tell us a little bit about what you did.
I went through the IRB board and got approved to administer a survey to Wiregrass residents who utilize payday lending. And
you said IRB, and that's
yes, Institutional Review Board.
For those of us in the academy, we know what that is, and those are feared letters. But if they're average viewer, they probably doesn't know what that is.
Yes, it's the Institutional Review Board, and they make sure that you're following ethical guidelines and you're not harming the participants, and that your studies.
Okay. And so you managed to navigate your way through that whole approval process, and then you went out and conducted some surveys, face-to-face?
Yes, they were in person, that they were administered by paper, and they filled them out anonymously.
And it was customers of payday lenders, right?
All of them had at least once utilized the services of the payday lenders.
Okay. And folks are from around different locations here in the Wiregrass. Well, tell us a little bit about what you found when you asked them these questions. How often, were people satisfied?
Overall, they were extremely satisfied. It was close to the national studies that have been done. They were a little more satisfied here, but it was almost the same. And no one wanted to have payday lending banned. So.
And how often were most of the people that you were talking to using payday lenders?
Most were only using it a few times a year. They said that they would consider their use moderate, not anything more than moderate.
And one issue that is often comes up is a number of critics of payday lending suggest that the average customer doesn't really know the full terms and conditions that they're getting into. They think they're getting one kind of deal, and then maybe whether they don't read the fine print or don't understand that how much they have to pay back. And so a lot of critics argue that payday lenders are somehow manipulating people because they're not really disclosing the full terms and conditions of the loans. What did you find when you asked people?
I took that into consideration because that's a really commonly used argument. And I asked them if they felt that they understood the terms and conditions. Almost everyone felt that they did. There was one individual that said that it could be a little bit better, but.
So people are generally satisfied with their experience. They're using it fairly infrequently, and they seem to know what they're getting into. So I guess that sheds some evidence or light on the questions of whether payday lenders are really manipulating or taking advantage of their customers, right? And let's see, you also, we mentioned earlier, but your survey found some evidence to back up this point that a lot of the people who are going to payday lenders don't necessarily have a lot of really good other options, right?
That's correct. I mean, they said that they don't have adequate savings. Almost everyone said that they don't have the savings. And while a few people did have credit cards and a few other options, there were some people that said that they would bounce checks, and that would be extremely expensive. And their other options weren't very good.
It seems like some people would be forced to sell their belongings
to a pawn shop. Yeah.
I do think it's kind of interesting that 23% of your survey respondents did mention that they had credit cards, because that is one of the things that does show up on national surveys as well. I mean, it's not the case that every payday lender customer doesn't have a credit card or something. They do have some other at least. A credit card in many cases as an option, and a credit card which isn't maxed out to its max balances. And I think that's important because it really does also show that they find the payday lending option kind of attractive, right?
Yes, I think so. Because I had a idea that it might be because from what someone said that the credit cards are over a long amount of time, and the payday loan, it's pretty much by the time you get paid, it's gone. So they don't have the long.
And I think in some cases also loans don't always necessarily get recorded against your credit score, I believe, which again could be another
Attractive feature.
Another attractive issue, because if you need some assistance for a while and you bounce a check or you have a late fee on your credit card, that's going to be showing up on your credit report for months or years afterwards, and that's going to hurt your ability to get other credit. So there's a level of anonymity, I understand, that's probably attractive to the customers as well as the fact that they can get the loans relatively quickly, right?
Yeah, I think that's definitely key. If you got to up your credit limit or even apply for a credit card, go to a traditional commercial lender, that's a long, complicated process. But these payday lending loans typically go in and out. You're done in a few hours.
And that itself is an important thing to note, because compared to a bank, which might have a lot more time involved in terms of processing a loan, and payday lenders are already doing this in a relatively streamlined fashion and offering greater convenience, but also probably lower costs than traditional banks would have if they were trying to serve these customers, right?
Absolutely. I worked as a commercial credit analyst for about a year at a bank in Michigan, and we would do 25, 35-page reports on customers taking out commercial loans. We'd get multiple years of tax returns, financial statements. I don't think most people have financial statements available, so this is very complicated. You have to really dig into the finances and make a thorough evaluation before the commercial bank will make that lending decision. That time frame does not work for somebody in an emergency situation like we're talking about for the typical payday lending customer.
And another thing I think is worth pointing out is that since these are, quote, payday lenders, these are folks who are working and have jobs. So, I mean, these are individuals who are reasonably responsible. They're holding down a job. They're working. They don't have a lot of savings. They don't have, I think as you have very few of them indicated that they would have friends or family that they could go borrow from or ask to borrow this money from. They need money to help out with some of the bills and unexpected expenses of life, and the payday lenders are providing this, right?
Absolutely. During the dire circumstances where some unknown about emergency comes up, these people desperately need cash, and payday lenders are some of the few people willing to lend to these people under these circumstances.
Now, there's one point of controversy that often comes up in discussions about payday lenders, and that's a question, in one sense, reflecting what you saw, Christy, in your survey responses, that most of the customers claim that they're only using payday lending a couple of times a year, and yet things like the Pew Charitable Trust, the extensive survey of payday lending, quoted that like half or more of the loans are going to people who are in a cycle of repeat borrowing. They've taken out like 8, 10, 12 loans, one after another. Which is true here?
Yeah, so this can actually, I'm going to use an example of airports. So people always ask, what's the busiest airport in the world? And I've heard people respond, well, it's Atlanta, Georgia. But that's if you're looking at the number of planes taking off. If you're looking at the number of passengers, it's going to be JFK in New York. It's very similar in this type of response here because there's a lot of people taking out these loans that pay them off within the 2 to 4 weeks, don't take out new ones, and don't even take out a new one within the same year. But there's also customers, a small percentage of them, that do take out a lot of these loans, and they are recurrent, and they get in a spiraling debt. And these are the customers that people are primarily concerned about when we're talking about the harm, because there's a lot of people that benefit from payday lending, but there are certainly people that get trapped in this circle of debt.
So to some extent, this is just a mathematical thing as we're trying to illustrate here. Most of the customers are taking out a small number of loans. This handful that are taking out a big number, they are going to weigh in very heavily on an average. So in some sense, that's one case where both sides are pointing to the same numbers, and there is something valid in their statement. So it's not inconsistent.
Yeah, absolutely. You can slice the data different ways, and it's important to look at it from all angles to get the comprehensive picture of what's going on.
So if we do consider now, say probably the minority, the small number of payday lending customers who do find themselves trapped in the cycle of repeat borrowing, it might seem like they're making themselves worse off through their use of payday loans. I mean, as an economist, we're generally pretty reluctant to say that people are making themselves worse off, right? But I mean, we can maybe you agree that. Cami, or are you willing to say that?
Yeah, so the important thing is take a broader perspective and say that there are lots of different products that we use on a daily basis, from cars to more crazy things like jumping out of an airplane, to solo rock climbing. There's a lot of things that we do and we allow people to do in a free society, some of which, with perfect hindsight, may have been a mistake after the fact, right? If I go and get in a car wreck on my way home today, I'm going to say, man, it is a mistake for me to drive a car when I live so close to campus. Perfect hindsight, I might have said I should have walked. But with the available evidence ahead of time, with most people using these products in a safe and secure manner, self-reporting that they benefited from the availability of payday lending. In a free society, it really would be a mistake to try to shut down that opportunity that really helps out a lot of people in dire circumstances just because a few people are harmed. It's much better to explore options for helping those few people that are harmed, so to speak, from payday lending.
And given the fact that, whether it be credit cards, student loans, other types of home equity loans or whatever, I mean, there are lots of ways people can borrow money, and we certainly see. And some people borrow too much. I mean, the lure of money that you can have now, like, as you always had from the idea of the money store. You can go and get money at the money store. Who doesn't want money? I mean, and that does end up leading a lot of people into trouble. But I think it is an important question you have to think about, and probably think about even outside of the context necessarily of the payday lending debate. It's like, where do you come down on that basic issue? If a lot of people can use the service and make themselves better off, but a few people are going to make themselves worse off, then, how do you view that trade-off in society, right?
Yeah, and plenty of high-income people take out mortgages that they can't afford, too big of a bite, and they end up going bankrupt. That certainly doesn't mean that we should take away that the availability of mortgages to everyone and just say you have to have full down payment, because that's clearly going to hurt those people that cannot afford all upfront, put down all the costs for that house.
Well, we've talked about a number of the different ways which I think payday lenders are serving their customers, and customers see that they're being served. But some of our viewers might still have a problem, or be unsure about the whole notion of payday lenders seemingly being able to get rich from charging people who are in hard circumstances, hardworking folks who have some unexpected bills. They don't have any savings. They have to go to a payday lender, and they have to pay 400%. And you're just and they're just like again, sharks making themselves rich off of off of people in dire circumstances. And so, what would you say in response to that this type of assessment?
Well, I mean, for one, they're not making as big of a profit as people might think when they hear the huge annual percentage rates that are being charged. Their profits are around 4%, which is lower than a lot of other industries, because they have high overhead costs, and a lot of people default on these payday loans because if they lose their job or they just don't pay it back, then they're out the money. So they actually don't make a lot.
I mean, one level, it seems kind of amazing. I mean, how can you be charging like $200 fee for every $100 you're getting, and not make a lot of money off of that, right? But I guess it's true, isn't it?
Yeah. So when they look at the evidence, as Christy mentioned, payday lenders, the net profit margin is fairly low, especially in comparison to commercial lenders or your average Starbucks. And one of the key things to take in mind is the payday lending is attractive because of availability. That means they're open long hours, they're paying for electricity, they're paying for staff to be in those stores. If the off chance that someone comes in and needs that loan, there's also a high default rate, as you would expect. There's no collateral securing these loans, so if they don't pay that loan back, and it cycles into more and more debt, they're unlikely to get paid back, and they're going to lose out to more secured creditors. So that risk that they have to eat the cost on any loans that are not paid back decreases the amount of profit available in this industry.
There's another way to think about it is that most Americans would probably think commercial banks are relatively greedy, and if payday lenders were making so much profits, don't you think like commercial banks would want to get in on the business there? So So now let's come down to the question of, what should the government do here? In particular, should the government do something like they say ban payday lending? And Christy, you asked your survey respondents a number of questions related to this. What should the government do?
Yes, I did.
And would they think they'd be better off? Tell us about this.
Well, a full 100% said that they were not in favor of the government banning payday lending. There were a few people that wanted to limit the number of loans that you could take out or the amount, because they probably thought that there were those people that got into a vicious cycle of debt. And they were concerned about that.
But even in those cases, the strong majority were saying they don't want any kind of restrictions, right?
Most people were not in favor of any sort of government restrictions.
No. So then if the government wouldn't be able to, if we think that maybe banning payday lending would be a bad thing, what, if anything, could we do, or what might be able to help out the customers of payday lenders?
Yeah, so there's a range of options that economists recommend, given that we want to focus on that small percentage of customers that get in this vicious circle of debt. And that can range from requiring more financial disclosure, uniform financial disclosure. I myself am actually a big advocate of the voluntary certification. There's actually payday lending groups out there that will allow payday lenders to get a voluntary certification that says that they provide adequate information, it's readily accessible, they monitor it and make sure that they're abiding by all the requirements for that certification. And that's just an assurance for customers to know, hey, this is a good payday lender, they abide by these voluntary restrictions. If you really think about it, payday lenders themselves don't want their customers to get stuck in this debt. As I mentioned, likely they're going to lose out if they're going up against unsecured creditors. They don't want customers that keep racking up the debt. The more debt you incur, the less likely you are to pay it off. They'd much rather have you pay it off in the 2 to 4 weeks that they specify in the agreement. So given that, they want to do their best to make sure customers are financially aware of the situation, what they're getting into, what the risks are, what the costs are, and to the extent that these consumer groups can ensure that they are voluntarily abiding by this, that will better help customers. Of course, as I mentioned, there are plenty of economists that also recommend mandated government financial disclosures as well.
Well, and I guess one of the problems we ultimately have here is, this strikes me as a problem of high costs. The attempting to provide loans to the customers of payday lending is just simply something that has high costs. That's why even charging these high rates, they're not making it much in the way of profits. And you can talk, any kind of policy options you want, but ultimately what would be, I think, most helpful here is if we could somehow lower costs. But government can't just pass a law to say costs are going to be lower. What we ultimately sort of need is innovation in this industry. And are we going about getting innovation the right way?
Yeah, so as you mentioned, one of the main costs that the payday lenders face is regulatory costs, and the more we add on more regulations, the more that cost is going to go up, the less competition there's going to be, and the less innovation. I think we definitely need a policy that encourages more competition, more innovation. There's lots of different technologies that you could imagine being used for peer-to-peer payday lending and things like that. And I'm curious to see what those are, and government regulation, I think, will only prevent them from emerging.
Well, I guess also we could probably not demonize the payday lenders and maybe encourage a few more folks to get into the business. Well, thanks very much for coming on the show, both of you. We enjoyed it, and thank you for joining us. Join us again next time for another EconVersations.
The opinions expressed on this program represent the viewpoints of individual authors or contributors and do not necessarily reflect those of Troy University.